What's going on? Henry here. We're going to discuss how you can get a huge discount on buying call options. This is a small account strategy, and I'm going to show you how to open and close this strategy for a profit. In the private Discord, I prefer to sell options, but the strategy I'm going to discuss today is exceptional at lowering your upfront cost of buying call options and giving you great leverage on a stock rising without needing much capital. This is a small account strategy I do recommend, especially for accounts under $1,000. This spread strategy involves opening two options, one that is betting on the stock rising and the other bringing in premium, lowering your cost of doing the first option. In just a minute, I'm going to show you an example, but here are more benefits and how this will grow your portfolio. The debit call spread you purchase is very cheap and you're limited to only lose what you pay for the option spread. The amount of profit that you make is also predefined. It's capped, but as you will see, it will have a 3x return in most cases. Although you won't have an unlimited upside return like a call option, it's so cheap to open these trades that it's harder to lose money in most cases, and you still get amazing upside potential. Amongst all spread strategies, the debit call spread is one of the most popular ones. This strategy comes handy when you have a moderately bullish view on the stock. Now, let's go over an example and cover strike prices, stock selection, and closing out this spread. All right, so the trade that I'm going to be making is going to be on SoFi stock, as you can see right here. SoFi is really cheap. It's at $6.25. You can run this strategy on a number of different stocks. I don't really care which one you pick, as long as the stock has either sold off, so you believe it's going to pull back up. For SoFi, it's down 33.33% in the past month, or just a bullish stock. Maybe we can even use something like Apple. So let's actually do an example of Apple. It's a much larger stock, and I know a lot more people are going to be interested in Apple potentially than SoFi. So let's use Apple. Currently, it's sitting at $159 per share. Now, Apple does have some strong momentum on the downwards, but let's just say that this week the market is going to open up and we're going to see a lot of bullish movement. Again, it doesn't matter which stock that you pick this on, as long as your view is that the stock is going to pull up and you want to buy call options. But instead of buying call options, doing a debit call spread is a way more profitable and powerful strategy to use. So let's say that we think Apple stock can go back up above $170 per share. Currently, it's sitting at $160 per share. So we think it's going to go from 160 to 170. Not a whole big swing, right? This is not crazy, just $10 for Apple. All right, so what we're going to do is we're going to click trade Apple options, and I'm using Robinhood platform. By the way, if you don't use Robinhood, make sure to use my link in the description. You can sign up, get some free stocks by opening up an account. You only have to fund it by, I think, a couple dollars. And I do like Robinhood. There is some issues. No brokerage is perfect, but they're free. They don't charge any fees, so that's why I ended up using them. All right, so I'm looking at buy a call option. Now I do want to pick my expiration date for a debit call spread. You want to pick an expiration date that is potentially 1 or 2 weeks out, but most importantly, you just want to pick a debit call spread, or you want to open up this call option on a stock that has some type of catalyst or some type of event. So let's say that Apple has earnings on May 11th. So I'm going to end up picking the May 13th expiration date because that's going to capture in earnings. Now, very simple, very easy. You go to buy call option, okay? We have picked the May 13th expiration date. Now, let's say that we think it's going to be about $170 per share after it reports earnings in this example. So now you're going to end up buying a $165 call option. If you buy this call option right here, it's going to cost you $463. Not a lot of money, but then again, it's not a little money either for a small portfolio. So instead of paying $463, right, buying this call option, just crossing your fingers and hoping that it goes up, is actually a little bit better of a situation that you could put yourself into. So let's say that you think it's going to go up to 170. Well, there's no point of actually just holding a call option if you don't think it's going to go up to like 200 or that much higher than 170. If it stops at 170, then you can actually go ahead and sell the $170 call option. Since Apple is unlikely to go past $170 in this example, let's say, then you can sell the $170 call option. You still get to keep this $165 call option. So you're still long, you still have a $165 call option, but now you're going to sell the $170 call option. Now, if you'll notice, instead of paying $463, you're actually collecting income. You're collecting the $170 call option premium of $269. So you're reducing your cost by $269, but you still have a very good upside. Now, the upside is right here. But first of all, your total cost went from $463 down to less than $200. So you're literally paying 50% less for buying a call option than just buying the call option without selling this $170 call option. So now you have a really big subsidy. You have so much less capital that you have to put up front, and now you still have a really good upside. So your upside max profit potential here is going to be $306. Now your max loss is only $194. So your return to risk ratio is pretty favorable here. It's about 1.5. You're taking about $1 of risk. You're having about $1.50 worth of return here. So $306 is your max profit and your max loss is $194. Now this is really important, your break-even price, because your break-even price isn't $165. Apple, if it touches $165, that's good. Now this option is in the money. Well, it's at the money, but it's in the money now. And as it rises, it's gonna stay in the money, right? But your break-even is actually $166.94 because your total cost is $1.94. And because you're paying $1.94, you need to add that to the strike price of the option that you're buying. So now your break-even right here, as you will see, is $166.94. And from there, you start making a profit. In the other situation, check this out. If I get rid of this $170 call option, now you need Apple to go a lot higher. It's not $166.94, whatever it was. It's $169.65. It's a whole $3 more now. It's a lot more expensive. And basically, if you think Apple is going to be $170 per share, you don't really have that much more room for upside because, well, you're breaking even at $169.65. So if Apple goes to $170, you can only make $35. You're literally just pulling in $35. However, you do have an unlimited upside, but this is Apple stock. So let's say that Apple isn't going to have a lot of volatility, something like a SoFi or a Tesla or one of those other big volatility stocks. So using this strategy is way more profitable on those big stable companies like Apple and Amazon and maybe Microsoft and these other big stable companies that you do want to bet on, you do want to be invested in, but you don't necessarily want to pay the big upfront cost of buying the stock and even buying the call option. I'm giving you an alternative to pay a lot less by selling this $170 call option. If you want to join the Option Coaching Academy for my coaching and all of my plays, you can click the first link in the description.